Hi guys, welcome back to my channel, No Anxiety Investing, where you can invest with peace of mind. Today we're going to look at something a little bit different, a little bit off the beaten path. We're going to be looking at BMO's Canadian High Dividend Covered Call ETF, ZWC. First, we got to take a look at what a covered call ETF is. There seems to be some confusion out there regarding these things and if they're good, if they're bad, who are they designed for, and why do they yield so high. If we take a look here, it's currently yielding 6.88%, and that's if you bought it today. If you bought it 6 months ago over here where it's under $15, wow, I don't even know what that yield is, but that's over 10, okay? That's really, really high, a great amount of income. But let's see why this yields so high. Let's take a look at their top holdings, and this is going to help us understand where their yield is coming from, okay? So we got the CIBC is the biggest holding. Okay, if you bought this by yourself, it yields close to 4.6%. Then Nova Scotia, this yields close to 4.6%. Again, Manulife's just over 4, Nutrien's over 3, Bank of Montreal's in the 3 range, Bell is 6, Enbridge is 7, so on, so on, and so on. So you'll see their highest holdings do not yield as much as the 6.88% that they're giving you for owning this fund. So you might be asking yourself, where's this extra money coming from? How are they paying you? How are they paying you guys monthly, right? All right, here it is. The asset managers at BMO use options to come up with the extra money, okay? The distributions are monthly. They are paid of any net income and or return of capital and any realized capital gains. So they're playing the option wheel with all these underlying assets. They are taking their current yields, which are good on all these companies. They're good. They're averaging in the 4% range, and they're selling options on them. And through these contracts, they're making up the additional income. Now, these distributions that are paid monthly are not guaranteed to be paid out. They need to make money. So if a market is flat, there's not a lot of ups, there's not a lot of downs, the market's just trading relatively flat over a period of time, this ETF is going to make good amounts of money because the option wheel could be ran. They could buy and sell and make a profit and keep buying back in. It's not a problem. This is fantastic. But over the long run, what do we know about the market? It goes up. All the indexes go up over a period of time. So this is where things get a little bit tricky. Let's take a look at the 5-year chart here, guys. If you had bought this in 2017, you would have paid $20 for this ETF. Okay, fast forward, it's 2021 and you are down. It's currently just under 18. How would you feel about that 10% loss over such a large period of time? Well, you were getting huge monthly distributions for those years, so you're living off that income. It shouldn't bother you that much. That's why this type of ETF is for a specific type of investor. This is for an investor who wants to live off their distributions. They want to maximize their earning potential. This is usually for an older person, okay, who doesn't care about capital gains, because if we compare something like this ETF, these covered call ETFs, you know, over a 5-year chart, if you just were to buy the underlying holdings like the CIBC, TD, Enbridge, over the 5 years you would have made a lot more money in capital gains just owning the underlying assets. However, if you need to live off this income, you'd be doing way better just to take this yield and run with it, okay? So that's who this is for. This is for the traditionally older people, people who are maybe financially independent, retire early, and they want to maximize their monthly income. This is who this is for. It's not for everyone. It's not for a long-term investor. And when I say it's not for a long-term investor, I mean, you know, having a small percentage of your portfolio in a covered call ETF is fine. But you just need to remember, you're not going to see those huge gains. So if you're going to hold, if you're a buy and hold investor, and if you're going to wait 20, 30 years, you really are not going to do well on this investment. It's going to be flat or down a bit or up a bit. It'll be almost nothing. Okay, so if you want to keep it around a part of the income portion of your portfolio, you know, under 5%, that's fine. It's not a big deal. But just, you know, don't expect this to help you retire one day in 30 years, okay? You're not going to get that out of this. So this product is good. I would recommend it depending on your situation, okay? Don't be afraid to hold a little. Just don't go all in. Just quickly before we wrap up, I just want to talk about the management expense ratio here. You see it's at 0.72. Okay, people who buy a lot of ETFs might think, hey, this is really high, guys. ETFs are usually like 0.1, 0.2. Okay, they are, but this is a covered call ETFs. They traditionally have higher management expense ratios because it's more active, it's more hands-on. You need a group of people making these option trades for you all the time, okay? So it is more work That's why there's a higher MER. It's not a big deal. It's very acceptable. It's still under 1%, right? If you know, think about 10 years ago, if you went to go buy a mutual fund, you're talking about 2% is on the lower end. So this is still fantastic. This is a good product. Don't be discouraged by this. Alright guys, that was a quick look into this covered call ETF. This is a popular Canadian one, that's why we're talking about it here today, but there's a ton of them out there. You can get higher yields or distributions, you can get lower ones. It depends on what you want to invest in. Always take a look at the underlying investments, okay? This is what you're dealing with, this is what you own at the end of the day. The rest of the yield is just based on how much money they make on their options, okay? So this is a pretty good one to own if you're going to own this type of product. I hope you liked the video. Like and subscribe if it helped you out, guys, and let me know if you own it or if you're going to be buying some other covered calls in the future. Alright, have a good one.